remind me on the question. I'm waiting. Good. Question 4. Question 4B. So let's go to question 4B. Smart Furniture makes and sells 3 types of sofa sets, namely American, Butterfly, and Comfy. The management accountant of Smart Furniture Limited has provided the following budgeted information for the coming period. So we are given that the company's budgeted overhead costs for the coming period are, we are given that the overheads are currently absorbed to products based on assembly labor hours. Production of each type of sofa set takes place in batches of 50 units. The company has also provided the following estimates for the coming period. We have machine hours, direct labor hours, and number of customer orders. The management accountant has just run of activity-based costing and would be willing to apply it. You are required to get a budgeted profit statement using conventional absorption costing using assembly labor hour rate and Roman 2 activity-based costing. Activity-based costing. So this question, that is question 4B. Question 4B is on what we call reporting methods. Reporting methods. Now, reporting methods, we have the conventional, and the conventional captures what we call absorption costing and marginal costing. And then we have what we call activity-based costing. So here we will begin with conventional absorption costing methods. Costing methods. Costing methods. So in this one, we begin to compute the OAR, the overhead absorption rate. The overhead absorption rates. So the overhead absorption rates will be budget overhead costs, you divide by budget labor hours. You divide by budget labor hours. Budget labor hours. So the budget overheads is 10,980,000. $10,980,000. The labor hours will be, you take the 900 units of the American times, ukiangalia in the labor hours, they require 7 plus 800 times 5 plus 1,000 times 8. So work out that and give me the answer. Work out that and give me the answer. Work out that and set the answer. Beth, you appear 2 times. Maybe you log out 1 gadget. You log out 1 gadget, Beth. So the answer is 600. So this is 600 per hour. 600 per hour. So with that, we are going to have budget income statements, budget income statements, budget income statements. Now in the budget income statements, we will have details, and in the column of details, we will bring selling price. We will bring selling price. Then we will say so you bring the, then you say less prime costs. When you get the prime cost, when you less the prime costs, the answer you get is called contribution margin. Then you less overhead costs. Then you get profit per unit. Profit per unit. Total units. And then total profits. We are going to see that. Profit per unit, total units, and total profits. And total profits. So we draw a table of that design. There are three products. The first one is called American. The next one is called butterfly. The next one is called comfy. It's called comfy. So design that, tukimaliza uniambie finish so that we pick up from there. Have we finished drawing? Yes, Eva, you have finished. What about the others? Yes, Beth. Timothy. Wamosie, good. Aika, I think Aika has come in a bit late, so she should be joining us, catching with us. So, when you look at the data given up there, the selling price for America is 40,000. For butterfly, it is 20,000. And for comfy, it is 30,000. Then there is what is appearing like price cost. It's supposed to be prime cost. Now, prime cost is the total of the direct costs. Direct material cost, direct labor cost, and any other direct costs. So this one we are told they are at 5,000. This one we are told it is 16,000, and this is 24,000. So the contribution margin here is 5,000. This is 4,000, and this is 6,000. This is 6,000. So the overhead per unit, will be, for this one, it will be 600 times 7. 600 times 7. That is 600 times 7 is 4,200. This other one is 600 times 5. That is 3,000. And then 600 times 8. That is 4,800. 4,800. So the profit per unit is 800, and the number of units are 900. So if you take 800 times 900, you record 720,000. Then this one is 1,000, and the units are 800. So this gives you 800,000. Then here the profit is 1,200, and the units are 1,000. So that gives you 1,200,000. 1,200,000. So once you're through, we proceed from there. Can we proceed? If you are okay, you say yes so that I proceed. Rika says yes. Okay. So we now go to activity-based costing. activity-based costing method So I want us to do it in a tabular format. We have the cost pool. Then we will have budget costs. You divide by budget cost driver. It gives us the OAR. You will get the OAR. So cost per unit of product American butterfly and comfy So we can have it that way. Because our original model, our time is 450 minus 800 I. Is that correct? Oh, so that I is control remains unchanged. What is changing is the element. So if we are okay with that, the first cost pool is processing services. Processing services. So the processing services, the budget costs will be 3,480,000, and I want us to use the machine hours. I want us to use the machine hours as the cost driver. So that being the case, we will say 900 units times 4 plus 800 times 3 plus 1,000 times 6. So work out that and send me the answer. Send me the answer there. We can say that IS equals LM. IS equals LM. Minus 500I equals Waiting for the answer. $783.78. Is that what everyone else is getting? I need at least 2-3 people. At least 2-3 people to agree on the answer. Only Haika has given. Beth has given a different answer from Haika. So I need that person. Yeah, 290. So Haika, look at your answer. It is supposed to be shillings 290 per machine hour. It is 290 per machine hour. Shillings 290 per machine hour. So when you're told to get per unit, you take these 290, you multiply by the machine hours that are there, and that gives you, if you take 290 times 4 is 1160, and then 290 times the machine hours for butterfly, they are 3. So 290 times 3 is 870. And then 290 times 6 times 2 is 1740. So Haika, did you rectify? Let us go to the next one. Assembly services. Assembly services. So for assembly services, I want us again to use the labor hours. I want us to use the labor hours. So you take the amount for assembly services as 2,562,000, and the labor hours are 900 times 7 plus 800 times 5 plus 1,000 times 8. So tell me it is shillings what? Give me that answer. Yes, Haika, good. So give me the answer to that. Yes, Beth says 140, Eva 140, they're in agreement. So it is shillings 140 per labor hour. Per labor hour. Shillings 140 per labor hour. So if you want per unit, if you're looking for per unit, utakuja hapa useme ni 140 times 7. 140 times 7, you get 980. Then hapa 140 times 5. So 140 times 5 is 700. And then 140 times 8. 140 times 8, you get 1120. You get 1120. The next one is quality control. Quality control. So you are quality control. This one for quality control. I'm going to use the batches. I'm going to use batches, and the cost is 1,930,500. Batches for the production. If you look at information 3, it says that production of each type of sofa set takes place in batches of 50 units. So if you want to know the batches that were there for American, it will be 900 you divide by 50 plus 800 you divide by 50 plus 1,000 you divide by 50. So those will be the batches. Those will be the batches. Work of that figure. Waiting for the answer. Yes, Eva says that 5,750. Someone else to confirm? Yeah, even Beth, that 5,750. So this is shillings, that 5,750 per batch. It is per batch. Is it per batch or per setup? Yeah, per batch. It's per batch. So when you come now here to get per unit, you will argue like this, that 5,750 times 900 out of 50. Then all these you divide by 900. All that you divide by 900. The same case here, that 5,750 multiplied by the batches which are there, 800 out of 50. Then all this you divide by 800. The same case here, that 5,750 multiplied by 1,000, which is divided by 50. Then all these you divide by 1,000. All this you divide by 1,000. So let's start getting the answers. So this one I'm getting 715. This one I'm also getting 715. I'm also getting 715. I'm also getting 715 there. Okay. The next one is called selling and administration. Selling and administration. Now, for selling and administration, the amount is $3,007,500. So this one we are going to use the customer orders, which are 30 plus 40 plus 50. So this one I can also quickly get in by saying 30 plus 40 plus 50 equals times 3,007,500. We get 25,062.5 per customer order. Per customer order is per customer order. So now from there, what you shall do is to come here and argue like this. You get this OER 25,062.5 times 30. You divide by 900. Then 25,062.5 times 40, you divide by 800. 25,062.5 times 50, you divide by 1,000. So times 30 divided by 900. This will be 835.41, or we can just work with 42. Then 25,062.5 times 40 divided by 800, 1253.125, that is exact. 25,062.5 times 50 divided by 1,000 is 1253.125. So I think we are okay. And as such, then we quickly now proceed to prepare the income statements. So budget income statements. Budget income statements. We have details here. So once again, we bring the selling price. Then we say less prime costs. And when you say less prime costs, the figure you get, tulisema inaitwa contribution margin. Then you say less overhead costs. Now the overhead costs, we have several. The first one anaitwa processing. Huyo mwingine tumemuita assembly. The next one is quality. The next one is selling. So you can see this breaks them down. And when you do that, you get unit profit or profit per unit. Then you bring total units. And after bringing total units there, you are now able to tell your total profit is how much. Your total profit is how much. You are able to tell your total profit is how much. So the first product is called butterfly. No. America. It's called American. The next one is called butterfly. So once nitafika hapo, so that I will, after I clear this, I bring the third one. So I can actually start here. For the American, in processing, the per unit is 1160. Assembly is 980. Quality is 715. This is 835.42. Butterfly, this is 870. This is 700. This is 715. 1253.125. So with that, I'm in a position now to clear this space so that I get where to write config. So config, this one it has 1740, 1120, 715. Hizi zinafanana. Kama nimekopi vibaya. 1253.125. Is this one okay? I'm asking whether this one is 1253. Okay, good. So if that is the case, The selling price we just record as we had 40,000. This is 35,000. So the contribution is 5,000. Then this is 20,000, 16,000. So I have 4,000, 30,000, 24,000, and this is 6,000. So sasa tasema 5,000 minus 1160 minus 980 minus 715 minus 835.42 equals 1309.58. The number of units are 900. So if I multiply by 900, I talk of 1,178,622. I hope we get into 4,000 minus 870 minus 700 minus 715 minus 1253.125 is 461.75 times 800, 369,500 minus 1740, 1120 minus 715, 1253.125 is 1171.875 times 1,000. This is 1,171,875. Once you finish that, you tell me finished. And even as you write, you can see the activity-based costing is more involving compared with the conventional. If I had time, I would have shown you that the total profit is the same. The total profit is the same. So someone would ask, why should we take that very long method, APC, to get the same answer we could have gotten if we use the conventional? But if you remember, one of the things I told you when we covered this is that activity-based costing is the most accurate. It's the most accurate. So you'd rather take longer and get it right than be fast and miss it. And maybe because I can remember, this one had a profit of 720, this one had a profit of 800, and I think this one had a profit of 1,200, something like that. Just to illustrate, you see, when you go with ABC for this product, this one is okay because you can see the two methods appear to agree. But for this one, there is a difference. Conventional showed you that this one has a profit of 800, but in actual sense, it has a profit of 369. Now, what happens if I use an example of human relationships? Because that is the same thing you see with the data. I don't know whether in your life you have ever come across some persons and you highly valued them, you treated them so well, and later on, when it is your day, you realize that they don't highly value you. That is not who they are. Have you ever met such persons? Let me see. People, you do good to them, you think they are very important. Yes, Eva, you have met them. The others, yes, Haika. Now, yes, Timothy. Yes, they are there for sure. Now, when you finally come to realize that that is how they are, you feel very bitter, you feel cheated, you feel betrayed, because you had committed yourself, you had done so well to them, you highly valued them, only to realize that they are not as good. So that's the same case here. When you use the conventional, in Aquadesha, there's a very good product. So you take good care of it. But in reality, it is not giving you anything much. On the other side, I'm also sure you have met some people who you have thought they are not very useful to you. You have not treated them well, you have disregarded them, but later on, you come to realize that they were very beneficial. They are very, very beneficial to you. Now that one, there are two possibilities. If by the time you realize that they are beneficial and you had also realized that you had disregarded them, maybe they had left. So if they had left, you were just left with regrets and wishes that you recognized them earlier. That is too bad. On the other side is if they had not gone away, then now you have an opportunity to rectify and benefit from them. So we always hope that they had not left. Now that is the case here. You see here, if conventional insurance is not a very good product, but in reality, it is the product that is giving us more. So ABC helps us to focus where it is beneficial. Where it is beneficial. Yule mtu anatusaidia na tunajua huyo ndiye anaweza tusaidia, we focus on that person. Yule mwingine anajifanya anatusaidia lakini hatusaidii, yule tunaachana na yeye. That is what happens. I hope that is well explained. We proceed now. So I hope you are able to see the video that I sent. If you watch all of them together with the others that are in my channel, you will be at par with the evening class. They were slightly ahead of you because they do slightly more hours than you, I think 2 hours per week. So if you watch that, you'll be at par. So make sure you watch all those videos. So let's now proceed to question 5A. Question 5A. S Limited has two divisions, namely B and C, under divisional manager. The two divisions plan to acquire some investments the month of August 2018. Additional information is that the cost of capital for both divisions is 13%. The current return on investment of each division is 15%. The division's planned investments have the following features. We have capital required for investment, revenue generated, net profit required for each of the two divisions, compute return on investment and residual income. So that is question 5A. Question 5A is on what we call performance measurements. Performance measurements. So we can have details here, or we can just, let me call them straight on divisions. Divisions, kuja hapa. Then here, I have what we call income. You divide by assets, multiplied by 100 is called return on investment. Return on investment. Return on investment. So tunaweza kwanza malizana na hiyo ndio tujue tunafungia wapi. So for division B will be there, C will be here. Sasa hawa maneno yao itakuwa namna hii. When you look at the data, we are told net profit margin is 30% for B. So it will be 0.3 times the revenue. The revenue of 450,000. Then you divide by the assets of 800,000. Then you multiply by 100. This other one will be 35% of the revenue, which is 210. You divide by, we will give the assets the 400,000 times 100. You do that quickly, you get 0.35 times 210 divided by 400 times 100 is 18.375%. 0.3 times 450 divided by 800 times 100 is 16.875%. Then if I come here and say income minus cost of capital, it will give me residual income. Residual income so sasa this will be 0.3 times 450,000, that is the income, minus the cost of capital, which is 13% of 800,000. And then this will be 0.35 of 210,000 minus 13% of 400,000. So 0.3 times 450 minus 0.13 times 800 is 31,000. 0.35 times 210 minus 0.13 times 400 is 21,500. Maliza niandikie finish. Yes, Eva, finished. Yes, Beth, Timothy, Amoshie, and Haika. Okay, good. So going to question 5B, Tech Survey Limited has several independent divisions. The company's tube division manufactures a picture tube used in television sets. The tube division's income statement for the year ended that 1st of March 2018, in which 8,000 tubes were sold, is given below. Then we have sales, cost of goods sold, gross margin, selling and admin expenses, divisional net income. The above cost of shillings 1050 to produce a single tube consists of the following costs. We have direct materials, direct labor, manufacturing overheads, and total cost per tube. The tube division has fixed selling and admin expenses of 3.5 million per year. Tech Survey Limited has just established a new division called TV Division that will produce a television set that requires high-resolution picture tubes. The tube division has been tasked to manufacture 2,500 of these tubes each year and sell them to the TV division. As part of determining the price that should be charged to the TV division, the tube division has estimated the following costs for each of the new high-resolution tubes. We have material, labor, overheads in total. Then we are told that to manufacture the new tubes, the tube division would have to reduce production of its regular tubes by 3,000 units per year. There would be no variable selling and admin expenses on the intercompany business, and total fixed overhead cost would not change. Assume direct labor is a variable cost, and then you advise on the lowest acceptable transfer price from the perspective of the tube division for each of the new high resolution tubes. Assume that the TV division has identified an external supplier that could provide the high resolution tubes for 100 shillings 2,000 each, and the tube division is willing to pay this price. Evaluate the effect of this decision on the profits of the company as a whole. So that question 5B . Question 5B is on what we call transfer pricing. Transfer pricing, and also what we call special pricing decisions. So the question requires knowledge from those two areas: special pricing decisions, and then transfer pricing. Now, when you are in the transfer pricing, I told you there are two things that you need to, there are three things that you need to identify. First is the company. We have the company here. We have the company, and then we have the supplier here, and then we have the receiver. We have the receiver. That is how the company is divided. That is how the company is divided. Now, specifically in the names of this company, or in the names of this question, the company is the one referred to as Take Some. It's the one called Take Some. That is the company. Then the one who is supplying is called the Tube division. And the receiver is the newly established TV division. So that one must be well identified. Must be well identified. Then there are several things that I told you regarding transfer price. Regarding transfer price, maybe I need to remind you. Regarding transfer price. Now, transfer price, I told you, to the receiver, it is a revenue. Sorry, to the supplier, it is a revenue. And to the supplier, it is a variable cost. It is a variable cost. So transfer price to the supplier is a revenue. To the receiver is a variable cost. And to the company, it has no effect. To the company, it has no effect. The transfer price it has no effect. Those are the three very important points that you need to note. There are two others that you should also be able to remember, that the revenue of the receiver is the revenue of the company. The revenue of the receiver is the revenue of the company, not unless the supplier had external revenue. If the supplier had external revenue, then all the external revenues will be the revenue of the company. And then the cost of the company are the cost of the supplier and the receiver, excluding the transfer price. So that is a recap of transfer pricing. The next thing is we said optimal transfer price. Optimal transfer price. Optimal transfer price. Optimal transfer price should be equal to the marginal. The marginal stroke relevant cost of the supply. The relevant cost of the supply. And remember, this is the one that we call the lowest acceptable price. It's the lowest acceptable price. So when the question asks you to tell us the lowest acceptable price, we need you to tell us the marginal or the relevant cost of the supplier. That is the tube division. So for you to do that, there are some things. Obviously, the relevant or the marginal cost are the variable costs. But you have seen that if tube division manufactures the tubes, they are going to lose out on the current demand. And remember the other day when I was teaching you, I told you, you don't see your customers as human beings, but you should see them as what? Let me see whether you remember. I told you, if you are a good business person, you don't see your customers as human beings. You see them as what? I'm waiting to hear from you. Yeah, Aika says income. Wamushie Timothy, money. Good. The correct word or the exact word that I used is money, although you can also call it income. So you see your customers as money. And I explained that all of us, we love money. So when you see your customers as money, you love them, you treat them well, and you give them everything they deserve. So when you're told that we are going to lose out on some demand, we need to identify how much we are going to lose. So Beth, I'm saying, according to the concept of special pricing, the marginal cost is the lowest price you should accept. The marginal price, the marginal cost is the lowest acceptable price, or the relevant cost. The relevant cost. So is that okay? So now I'm explaining the journey of getting the marginal cost, and I was talking of what we are going to lose. So let us do some analysis. Analysis table. Regular tube. Analysis table. Regular tube. Regular is the current one that they are selling. So we will have selling price. Now selling price, as you can see up there, it is 1,700. 1,700. You less variable costs. You less the variable costs. If you look at the breakdown that is given there, the first one is direct materials. Remember, any cost that is called direct is a variable cost. It's a variable cost, although not always. There are times they can be fixed. But for the purposes of this topic, they are variable. So we bring 3/8 there. Then we bring direct labor. Direct labor. Direct labor is 270. Then from there we bring overheads. Overheads. Now overheads, we are told 75% are fixed. So that tells you 25% is variable. 25% of 400, that must be 100. 25% of 400. Then we have the selling. Now the selling, we will get them like this. You can see up there, the total is 3,900 or 3.9 million. And the one that is fixed, we are told it is 3,500,000. So when you subtract, that tells you the variable is how much. And this one, you are supposed to apportion it to, or to share to 8,000 tubes. So you divide by 8. So you utasema 400 divided by 8 is 50. So that gives us 50. So with that now, give me contribution margin. Contribution margin. Give me the answer for the contribution margin from there. Okay, 900, good. 900. The next one now is we can get the analysis table. Analysis table. A new tube. A new tube. The analysis table. So the new tube, as you can see there, we have direct materials. Direct materials. Direct materials is 600. Direct materials is 600. Then we have direct labor. Direct labor is 490. 490. Then we have the overheads. We have the overheads, which we are told 2/3 are fixed. So the variable must be a third. So a third of 540. A third of 540 must be how much? 180. A third must be 180. Then there is something else that we need to bring on board. That is the lost contribution. Lost contribution. So the lost contribution is we are told that if we do these new tubes, we are going to forego 3,000 of the current tubes. 3,000 of the current tubes. And as I told you, you need to see the money. So the money is 900 per each of those tubes. So that tells you how much we are going to lose in total. But we are losing all this because we have chosen to make 2,500 tubes of the new one. So this is the one that will tell you how much is the lost contribution. So give me that figure. How much is it? When you say 3,000 times 900 divided by 2,500, 1080, good. So we have 1080. So now add those costs. Add 180 plus 490 plus 600 is 2350. And thus, lowest acceptable price will be shillings 2350. The lowest acceptable price will be so I think that is okay. The last question is evaluate the effect of the decision. So the effect. The effect on company decision, company profits. So this one, it has two ways you can follow. It has two ways you can follow. The first way, which I think the examiner, by distributing the marks, had in mind, was something like this. But this is not the one that we shall follow. The first way is like this, where you do the income statement. First of all, for the when we are making the tubes, so you get the profit of the supplier, the profit of the receiver, and the profit of the company. Then you go to make another statement where we buy, where we are buying the tubes. Again, you get the profit of the supplier, receiver, and the company. Now, the two profits of the companies that you get are the ones that will help you in saying whether the profits have gone up or down. Now, that one, we call it the total approach, where you bring everything together. But because we know how to make decisions, you don't have to go for everything. You just go for the specifics. And the specifics will be like this. If we decide to buy instead of making, if we decide to buy instead of making, there are some costs that we will not incur. Those costs that we will not incur will be our savings. So which costs are those? They are the cost of the new tube. We will not spend these 600. We will not spend these 490 for labor. We will not spend these 180 for the overheads. And we will not lose our 3,000 tubes. So this contribution will not be lost. So in other words, all these costs will be our savings. All these costs will be our savings. But for us to make this saving, we must now pay to someone else 2,000. We must pay to someone else 2,000. So the effect on our profit is that profits will increase. Profit will increase by 2,350 minus 2,000. I've already said this is what we shall save. And then we are paying out 2,000. Then this one is going to happen for 2,500 tubes. It's going to happen for 2,000. So our profits will go up by 875,000 shillings. I hope you have gotten that. Are we okay with that? Are we okay? Okay, so then we can call it a day at that juncture. We call it a day at that juncture, and then hope to meet in the next lesson. Thank you so much, and have a good day.